So in terms of bull markets, we believe that the current bull market, which started essentially about a year and a half ago, is quite young. And so, if you look at the history of bull markets, if you look on the right-hand side, that bar chart, that goes back about 80 years or so. Bull markets tend to last on average about 5 years. And on average, they tend to gain at least 150% over that period. Now, that's the average, but we've had periods, if you look at that blue bar chart back in up until from 2009 or in the 90s, where those both bull markets lasted for between 10 to 12 years. So bull markets tend to last for a very long time. And this particular bull market that we're in is extremely young. It's not even 19 months old. And where should it end? We don't think it will, but should it, it would be the quickest and weakest bull market we've ever had. So that's something to note. Now, a few other things to sort of look. If you look at the performance of the S&P 500 in the US, it's up about 12, 13% calendar year to date. But if we dig further, the market is not necessarily, moved in the same direction. It's driven mostly by some of those what's called the Magnificent Seven stocks, the Nvidias, the Google, the Amazons of the world. Now, it's interesting to know that the average stock's distance from its 52-week high is still 12% under. And if you look at the Russell 2000, which is essentially the small index over in the US, and that's down almost 30% from the average stock's 52-week high. Yet the S&P 500 is hitting all-time highs. And that's essentially driven by those large stocks. Now, if we were to remove the Nvidia from this calendar year gain of the S&P 500, the gain drops from 12.5% to 7.9%, and then it falls again to about 4% if we remove the Mag 7. So the point we're trying to make is that the market isn't necessarily expensive, and the majority of the move has been done by those large stocks which are benefiting from very strong tailwinds in the industries they operate in. But the rest of the market has a lot to gain, and we believe that's going to happen as soon as sentiment comes back into the market when rate cuts begin later this year and into next year.